Hello everyone. Let me first begin with the monetary policy review which recently concluded. This was the first time in India that we had a monetary policy committee which took a decision on the rate action, comprising people from the government as also from the central bank. For starters, it was a Tuesday that we saw the monetary policy. So Dr. Urjit Patel actually did a Shri Ganesh by cutting rates by 25 basis points. While this was not consensus view, this was broadly in line with what we at Kotak Mutual had envisaged, and this is what we have been communicating for a fairly long period of time. What really triggered this rate cut? So again, first is the CPI, or the consumer price index, the inflation number, which has printed a headline of close to 5%. There is a general expectation that this number will head downwards. So obviously the governor has taken comfort from the future inflation trajectory, which is likely to be on the lower side. Second, the other intriguing or the interesting part that we noticed this time around is that the real rate corridor, which is typically guided to us in the band of 1.5% to 2%, now we've been communicated it stands at about 1.25% for now. So honestly, that leads us to believe that the accommodative bias or the stance for more easing probably could be open. The third thing was with respect to the inflation target. While March 17 we seem to be on target for the 5% region, the 4% which has been tabled for March 2018 seems to have taken a little bit of a relaxation. Not to say that we are deviating from the target, but looks like we have some more time. So on balance, if you see, it was a fairly desirable outcome, and we believe that there could be easing going forward. How did the markets get impacted? The bond markets obviously were in a party mode, and the party continued. We saw yields soften further. As we speak right now, the 10-year is trading in the vicinity of about 6.7%. We clearly believe that there is headroom for further easing on the anvil. Could the 10-year trade in the band of about 6.5% in the coming few months? The answer is probably a yes. We do believe, as I mentioned, we expect another 25 basis points rate cut. Again, agnostic whether it is going to be in December policy or probably the Feb decision. But can the terminal repo rate be at about 6% by March 2017? Again, the answer is in the affirmative. So if this is the kind of market scenario, what should be the strategies that investors should focus on? I would like to confess that we've fairly been old-fashioned in this. So beginning of the year in our communique, we said that there could be rate easing much more than market anticipation. So duration or long duration funds should be the port of call or the overweight position. Gradually, we started receding the overweight position on fixed income on an incremental basis for fresh allocation by investors. So as at this point in time, we would suggest about 80 to 85% of fresh allocations in favor of short duration accrual funds, stroke medium term funds, and still continue to top up maybe 10 to 15% of the portfolio into long duration funds like gilt and bond. Treat the medium stroke short term funds as a cake and the duration funds like the icing. And I think it would be a very palatable recipe. We believe that it's time to stay invested, be patient, and I think the rewards could be forthcoming. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.